The Bank of England has hiked the cost of borrowing to its highest in 13 years. It's voted to raise the base rate of interest to 1% in response to surging price rises. It'll mean bigger mortgage bills for about 2.2 million households on variable deals. Malcolm Davidson is director at UK Moneyman's Brokers.
Yeah, so this is 4 months in a row now that interest rates have gone up, and I guess consumers are getting used to all this kind of stuff now, because it's not just mortgage rates, interest rates that are going up. It's everything from council tax to energy bills as well. But the Bank of England's remit is to keep inflation under control. We can all see for ourselves how prices are spiraling, and the idea behind an interest rate rise is to cool the economy off and make the cost of borrowing that bit more expensive. So that is their job to do. Luckily, most customers with mortgages do have fixed rates, so they're unaffected as of today. But of course, as those deals come to expire and they're ready to take out a new one, it could well have an impact on what their mortgage payments will be in the future. Yeah, so if you're on a variable rate mortgage, then the impact of a rate rise of this nature, if you've got an average size mortgage in the West Yorkshire area, it'd probably be an increase of about £25 per month on a 25-year mortgage. It could be more or less for some people. So just what they need when the cost of everything is going up as well. Yeah, luckily we don't come across too many customers that are on variable rates of interest. Normally they're decided to do that for a certain reason, like perhaps they're going to be moving house in the near future. But yes, most times they can change to a fixed rate. But of course, the fixed rates now are more expensive than they were at the back end of 2021 when the base rate was lower. So it's a knock-on effect eventually. Yeah, so you've always got some people in the market that need to move. For example, they're relocating due to a job or a separation or something like that. So you've always got people that need to sell and to move. But within that, you've always got other people that are possibly doing a move for aspirational purposes. They want an extra bedroom or just something by choice. And it's those customers that perhaps might be put off, not just by the mortgage rates going up, but by the cost of everything. So if you're thinking about going from a 3-bedroom house to a 4-bedroom, and you're thinking, oh, right, okay, my mortgage is going to be more expensive, I understand that. But they're now starting to think about the impact of energy bills as well. When there's any uncertainty like that in the market, then people tend to sit on the hands and not make those moves. So I think it's going to have a natural cooling off of the property sector across the summer, and we might argue that's actually been a good thing, because it's been absolutely ridiculous and property prices have risen by 1% per month over the last year, and clearly that can't sustain forever. Well, that's really interesting, because normally when a customer fixes their rate of interest, the 2-year fixed rates are cheaper than the threes are cheaper than the 4s and the 5s. That's normally the running order of things. However, something very strange is happening, in that the 2-year fixed rates are pricing approximately the same as the 5-year fixed rates. So that indicates possibly that what the banks are thinking, that rates are going to continue to increase for the next year or two, but it's not going to be a long-term thing. We're going to see a plateauing after year 3, 4, and 5, and possibly a reduction when inflation eventually becomes under control. But I think they've been a little bit slow to react. I think the Bank of England was trying to weigh up whether all this inflation was caused by pent-up demands post-COVID, or whether there was some genuine growth in the economy. Either way, we're now all having to pay for it. That it's usually an error, because you'd normally trigger an early repayment charge to swap mortgage mid-term. What they can be doing is keeping an eye on what's happening in the market, keep engaged with their original mortgage broker, and then you can swap deals up to 6 months before your current one comes to an end. You can lock into a new deal. So it's just to keep it under constant review, and always ensure that you're on the best deal. But what more can you do than that? The deals are the deals that are available at that particular time. And of course, we've become used to these ridiculously low rates of interest. But historically, rates were much, much higher in the past than what they are today, despite these recent rate rises. Well, I can go back much further than that. So back in the late 80s and across 1990, when we had double-digit inflation, we had interest rates up to 15%. Okay, so the average mortgage payment in those days would account for 50% of an average family's net take-home pay. So we're nowhere near those levels. And that's exactly what this is designed to do. It's to try and put off some of that consumer spending, to try and cool the economy down so things are under control, because we've been running above this inflation target now for some considerable time. And if we're not careful, then the cost of everything is going to run away with us. So it's very painful for us all. And this is a small rise, and most people are unaffected by this because they've got a fixed rate mortgage. It's not all doom and gloom, but by not taking action, we're just shoring up problems for the future.